Look, thank you all for joining us for this. This is our latest in our series of JobKeeper webinars, and look, perhaps for all our sakes, maybe it might be the last of the series. I would call the JobKeeper scheme unprecedented, but for the fact that I'm a little bit sick of the word. So instead, what I will say is that, look, we'll probably never see a scheme in our lifetime which has had such a large-scale impact on the Australian economy in such a short period of time. There's probably no more than 2 degrees, potentially even 1 degree of separation between everyone on this call and knowing someone who's either an employer on JobKeeper or an employee who's also on JobKeeper. So with that as the context, it's fitting that we have such an interest in the scheme, and more particularly the JobKeeper extension, which most people know as JobKeeper 2.0, which will be the focus of today's session. Before I get into the content, just a quick introduction and some housekeeping. So my name is Sam Mohammad. I'm a director in RSM Australia's tax practice. When I'm not doing JobKeeper, I also do indirect tax, so GST, stamp duty, payroll tax, and land tax, amongst other things. Joining me today are my co-presenters. So we've got Michael Watkins, who's in sunny Melbourne at the moment. He's a corporate tax manager. And sitting beside me, about 1.5 meters away, is Belinda Crowley, a corporate tax senior manager who also sits in Brisbane. We intend for the session to run for about 45 minutes and to leave about 10 or 15 minutes for questions and hopefully some answers. To that end, if there are any questions you think of as we go, please use the chat function at the bottom of the screen and we'll endeavour to answer it before we end the session. On with the session. What we intend to cover today, there's quite a lot in terms of content. We'll provide a very brief wrap up of JobKeeper 1.0 and where we are today with JobKeeper 2.0. We'll look at how you calculate your GST turnover and determine an employer's eligibility under the basic decline in turnover test. We'll also look at the circumstances in which the basic test is inappropriate and what are the alternative tests that an employer might want to use to be able to access JobKeeper 2.0, and how those alternative tests apply in different circumstances. We'll look at covering the various rates and amounts relevant to JobKeeper 2.0 in comparison to the more simplified JobKeeper 1.0 scheme. And lastly, but hopefully not least, we'll cover some of the more practical tips and traps and a bit of where to from here. So a bit of a brief overview of where we are today. The very start of the scheme dates back to the 30th of March, which seems like a lifetime, and for some, a few lockdowns ago. The government announced the scheme on that date, which included both the JobKeeper Act, which is essentially just a broad framework document, and the more detailed and complex rules around JobKeeper. These were passed or registered on the 9th of April, and then the 13 fortnights of JobKeeper 1.0 wrapped up a couple of weeks ago on the 27th of September. JobKeeper 2.0 was only announced in late August and was registered on the 15th of September with a start date of the 28th of September. One of the questions I've been asked a few times is if JobKeeper 2.0 is more or less designed for those businesses that are heavily affected by lockdowns and public health measures, such as those in Melbourne and Victoria, and those businesses that are unable to recover because the markets they operate in are essentially non-existent. So we're talking about the tourism, the hospitality, and the travel industries. Why doesn't the law just say that? You know, why is JobKeeper 2.0 still open to essentially every business? Really, there's 2 reasons for that. One is constitutional. So from what I understand, the government was unable to just isolate the scheme to Victorian businesses because potentially they could have breached the constitution. So obviously they wanted to avoid that issue. The second reason is, and probably the more practical and simple reason, is the government just didn't have the time to define who are affected businesses. How do you define who's travel? How do you define who's tourism, hospitality? what about those businesses that aren't actually in tourism and hospitality, but are service providers to those industries? And at what point do you draw the line? So I think from that perspective, the government's done the right thing to leave the eligibility as is, but to tighten how businesses can actually access the scheme. What you can see in the slide in front of you, and what we really tried to do is capture the essence of JobKeeper 1.0 and 2.0 in a page. Look, as much as I'd love to take the glory of this slide, because I think it's an excellent slide, I have to admit my only contribution is just the tagline of retain, retest, and reduce. And what I'm really trying to say there is that there are parts, and very large parts, of JobKeeper 2.0 that are essentially unchanged. So there is a large element in terms of the framework that we've spoken about previously that we don't need to relearn. Businesses that were eligible for JobKeeper 1.0 must requalify based on a series of modified eligibility tests, which is really just designed to wean recovering businesses off the scheme. So that's the retest element. And the reduce element is really just looking at the fact that the scheme, or the JobKeeper 2.0 scheme, is really designed to help smooth out the otherwise financial cliff that would have resulted if JobKeeper 1.0 was the end of the line. So really, to help bring this summary to life, I'll hand over to Michael, who will step us through some of the basics of JobKeeper 2.0.
Thank you, Sam, and good afternoon or good morning, everyone. As Sam mentioned, I'm going to be looking at some of the eligibility issues associated with JobKeeper 2. One of the most significant changes arising from JobKeeper 2 is the new actual decline in turnover test. However, in amending the rules for JobKeeper 2, the Treasurer did not remove the previous decline in turnover test that we had from JobKeeper 1. As a result, an entity is required to satisfy both the decline in turnover and actual decline in turnover tests to qualify for JobKeeper 2. The decline in turnover test is a once and for all test. As a result, entities that are registered for JobKeeper 1 have already met this test. However, the actual decline in turnover test must be satisfied at 2 points for full eligibility under JobKeeper 2. Once with respect to the September quarter, being JobKeeper payments for the period 28 September through to 3 January, and then once with respect to the December quarter for payments from the 4th of January through to the end of March 2021. Importantly though, if eligibility is failed in one quarter, let's say the December quarter, it is possible to come back into the scheme for the March quarter. Moving on, let's look at what you actually need to satisfy as far as the actual decline in turnover test is concerned. There's essentially a 5-step process, as you can see on the slide now, which starts with working out the entity's aggregated turnover, determining the relevant decline in turnover percentage, working out actual GST turnover, working out current GST turnover for the comparison period, and then ultimately running the analysis to see whether the entity is in or out of JobKeeper 2. As I said a moment ago, entities must satisfy both the decline in turnover and the actual decline in turnover test. And for entities who have already been registered under JobKeeper 1, the focus only needs to be on the actual decline in turnover test. However, there is some good news for entities that have not previously claimed under JobKeeper 1. Satisfying the actual decline in turnover test also means that the decline in turnover test is satisfied automatically. So while there are 2 tests under the rules for JobKeeper 2, in substance, if an entity meets the actual decline in turnover test, the decline in turnover test is also satisfied. So let's have a look at the actual decline in turnover test in some more detail. Firstly, the decline in turnover. These thresholds have not changed from JobKeeper 1. So if your entity is an ACNC registered entity, your required decline in turnover is 15%. If you're an entity with an aggregated turnover, and I'll come back to what aggregated turnover means in a minute, of less than $1 billion, sorry, then your turnover decline is 30%. And if you're an entity with an aggregated turnover of greater than $1 billion, then the decline in turnover required is 50%. So let's have a look at aggregated turnover. The decline in turnover tests require an entity to look at turnover in two concepts. As you can see on this slide, there's aggregated turnover and there is GST turnover. Aggregated turnover is relevant to determining which threshold, and in the context of for-profit entities, that's the 30% or the 50% threshold applies. Obviously, for not-for-profits and ACNC registered entities, it's only the 15% threshold. Aggregated turnover is a broad concept which looks at the total ordinary income of a business, and that's an income tax concept. Importantly, this concept of aggregated turnover also includes entities that are connected or affiliated with the subject business. Now, this includes overseas entities, parents or subsidiaries, or even sibling type entities where you have a common controller. On the other hand, if we look at GST turnover, and if we just go to the next slide. Okay, GST turnover looks at the value of supplies made during a period. Now this can include, or does include, GST-free supplies, but excludes input tax supplies. So they're things like interest or dividends that you may receive. One main point of difference around the normal definition of GST turnover is around GST grouping. For those listening who are employed by entities that are parts of GST groups, normally you would be disregarding any transactions between members of a GST group. For the purposes of JobKeeper, that concept has been switched off, so to speak. Each entity is considered on a standalone basis, regardless of whether it is part of a GST group or not. One of the other changes to the regular definition, and this relates to not-for-profit entities, and particularly deductible gift recipients, is donations. Gifts and donations are allocated to the period in which they are received. One of the other changes from JobKeeper 1 is around the attribution rules or the time of supply rules. Time of supply is a concept that is foreign to us in the Australian GST landscape. However, as you may recall, the Commissioner of Taxation did make some time of supply rules for the purposes of JobKeeper 1 to allow entities to determine when particular supplies were attributable to which particular period. As far as JobKeeper 2 is concerned, these rules have now been revoked and the Commissioner has made a new determination. This determination, in essence, tries to simplify the process and align the accounting method that an entity uses for its GST or BAS reporting purposes. So under JobKeeper 2, an entity will attribute supplies to a period for the purposes of JobKeeper based on the GST accounting method it adopted at the time of the relevant comparison period. So under the normal JobKeeper rules for JobKeeper 2, if you were looking at determining eligibility for payments up to December or the 3 January deadline, or 3 January date, you'd be comparing your supplies made in the September 2020 quarter with supplies made in the September 2019 quarter. So this latest determination from the Commissioner says that you just apply those same rules that you apply for your BAS to your supplies for JobKeeper purposes. There are, however, two exceptions. An entity that is unregistered for GST at all times, so is not registered now and has never been registered, may choose either the cash or the accruals method. The other exception is an entity that registers for GST after the end of the relevant comparison period. So using the September to September period, this might be an entity that registered on or after the 1st of October 2019. It would then use the GST accounting method it applied at the start of the turnover test period, being 1 July 2020. Let's have a look at a couple of examples. So in this example, and let's start by testing the September period, we can see that in the September 2019 quarter, this entity had GST turnover of $600,000. In the September 2020 quarter, this entity's turnover was only $350,000. Now, we are assuming that this is a for-profit entity and that its aggregated turnover is less than 1 billion Australian dollars. So we can see that the decline for the September quarter was 41.66%. As a result, and assuming all the other requirements are satisfied, this entity has met the required decline in turnover of at least 30%, and so is eligible for JobKeeper for the first 3 months of JobKeeper 2. When we look at the December quarter, so for payments after early January next year through to the end of March, we can see the prior year turnover was 530,000 compared to the December 2020 quarter of 380,000, which gives a decline of 28.3%. As that is less than 30%, this entity does not qualify, and so therefore it will drop out of JobKeeper 2 after the fortnight ended on the 3rd of January 2021. Looking at another example, and again, for these purposes, we'll assume this is a for-profit entity and its aggregated turnover is less than $1 billion. We have, for the September 2019 quarter, turnover of $600,000 and current GST turnover for the September 2020 quarter of $460,000, leading to a decline of 23.33%. That is lower than 30%, so this entity does not qualify for the first period of JobKeeper 2. So all JobKeeper payments will cease if it were indeed registered in JobKeeper 1. However, in the December quarter, things were a little bit worse for this entity. Its prior year turnover, comparable turnover, was 530,000. The current year turnover is only 360,000, which is a decline of just over 32%. As this is over 30%, then this entity can come back in for JobKeeper 2 and will receive payments for the last 3 months of the program. So this just demonstrates that just because your entity may be ineligible in one part of the JobKeeper 2 period does not mean that it is out forever. There is that option to come back in at a later time if you meet the required decline in turnover. And similarly with the first example, it does also show the importance and the requirement to retest once those December numbers are in, because if the entity no longer qualifies, then it needs to drop out of the system. So the next thing we look at is what really hasn't changed from JobKeeper 1. We still have the ineligibility tests. So a business that did not commence until after the 1st of March remains ineligible. We also have the same meaning of eligible employee. Now this is from the latest amendment, which came in with effect from the JobKeeper fortnights in August and was changed from the original rules, which specified employees must have been employed by the 1st of March, and changed that date to the 1st of July 2020. There is also the requirement to meet the wage condition, although there is a concession that has been given for JobKeeper, the first 2 JobKeeper fortnights in JobKeeper 2, and there is a date until the 31st of October in order to meet those wage conditions. The specified decline in turnover percentages have not changed. The same rules with respect to service entities are still there, as is the ability for AC&C registered entities to exclude government grants from turnover, and we do note that there is an election that needs to be made with respect to that. The integrity rules are still there, as are the enrolment processes. Payments will still be made monthly by the ATO on the lodgement of the monthly declarations, and there are also rules preventing more than one employer claiming with respect to the same employee. Also, the same rules regarding the tax treatment of JobKeeper payments are still in place. The Commissioner has made a number of alternative tests for entities that may not satisfy that basic decline in turnover or actual decline in turnover test, and Belinda will take us through those now.
Thank you, Michael, and good morning or afternoon, everyone. My name's Belinda, and I'm going to begin by discussing the alternative tests available to employers and sole traders for gaining access to JobKeeper 2, where the standard test is not satisfied. These tests are only available where there's not an appropriate comparison period in 2019. They can't be used as alternative tests merely because the standard test discussed by Michael just now has not been satisfied. And most of these tests are the same as they were in JobKeeper 1 with a few modifications. The alternative tests apply to change the comparison period for the purpose of testing whether the actual decline in turnover test is met. That is, they move the period to which the entity compares the actual GST turnover for the quarters of December 2020 and December 2020. As a reminder, ordinarily the relevant comparison period for those JobKeeper fortnights, as just discussed by Michael, for the fortnights between 28th of September and the 3rd of January, the comparison period is normally September 29 quarter, and the comparison period for JobKeeper fortnights in the period 4 January to 28th of March is ordinarily the December 2019 quarter. For entities which did not qualify for JobKeeper 1 but are attempting to qualify for JobKeeper 2, the alternative tests also apply for the purposes of testing whether the original decline in turnover test is met. And the original decline in turnover test can be assessed on a monthly basis. However, the actual decline in turnover test must be assessed on a quarterly basis. Therefore, each of the alternative tests can be modified to account for the monthly testing for those who were new to JobKeeper, but I'm going to primarily focus on the tests as they relate to quarters. So the first test listed up on the screen there relates to businesses which commenced after the first day of the comparison period, but before 1 March 2020. This test therefore does not assist entities which commenced after the 1st of March 2020, and the reference to commencing business is a reference to commencing any business. It does not apply where, for example, a new business line is introduced. Where the business is commenced between the first day of the comparison period and 1 March 2020, there are 2 alternative tests that can be used when calculating the GST turnover. The first of these tests effectively averages your GST turnover for each full month since commencement and then multiplies that average by 3 to give you a 3-month comparison period. This test applies where the business is commenced before 1 February 2020. If the business is commenced on or after 1 February 2020, the turnover for the month of February is averaged by day, and then that amount is multiplied by 29 to give you a monthly turnover. The second test, which can be used to calculate comparison turnover for a business commenced after the comparison period, but before 1 March, is simply to calculate the GST turnover for the 3 months immediately before 1 March 2020. For some entities, that will of course encompass the Christmas trading period and therefore may produce a good outcome, whereas for some businesses that were affected by the bushfires, this period may have had unusually low turnover. Tests 2 and 3 listed up there on the slide apply where there has been a business acquisition, disposal or restructure. And for these tests to apply, there must have been either an acquisition or disposal of a part of the business at or after the start of the relevant comparison period, or alternatively, in the case of the third test, a restructure. And the acquisition, disposal or restructure must have changed the entity's current GST turnover. What constitutes an acquisition, disposal or restructure is not further discussed in any of the explanatory material, and therefore these would just take their ordinary meaning. There is a requirement, however, that the acquisition or disposal or restructure change the turnover, and therefore if the acquisition doesn't actually result in the change, this alternative test won't be available even though technically there may have been an acquisition. The alternative test in this situation is to use the turnover for the month after the disposal, acquisition or restructure occurred, and then just multiply that number by 3 to get to a quarterly period. Where there are multiple acquisitions, disposals or restructure, the test can be applied separately to each acquisition, disposal or restructure. And this is different from the test in JobKeeper 1, where you had to use the month after the final event, which in some cases was a COVID affected period and therefore limited access to the test. The fourth test listed up there is of assistance to entities who have experienced significantly increased turnover, with the premise being that these entities no longer have the same business structure that they previously had, and therefore the comparison turnover needs to be calculated to account for that change. This test is available where either the GST turnover has increased by 50% or more in the 12 months immediately before 1 March 2020 or the 12 months before the test period. It increased by 25% or more in the 6 months immediately before 1 March or the 12 months before the test period, or finally, it increased by 12.5% or more in the 3 months immediately before 1 March or the 12 months before the test period. To test whether the increase is met, in the case where 1 March is used as the reference period, the turnover in February 2020 is compared to the period either 12 months, 6 months or 3 months earlier as required. And where the test applies, the new comparison period is either the 3 months before 1 March 2020 or the 3 months before the test period. The fifth alternative test available applies to those entities which are affected by drought or natural disaster, and to qualify, the entity must have conducted business or some of its business in a declared drought or national disaster zone during the relevant comparison period, or the drought or disaster changed the entity's current GST turnover. In this case, the alternative test is to use the turnover in the year prior to the declaration. So, for example, for the September 2020 quarter, if you were drought affected in September 2019, then you would be able to use the September 2018 quarter as your comparison period. Test 6 deals with businesses which have irregular turnover and allows these businesses to use a monthly average of their GST turnover for the 12 months ended at the beginning of the test period. And that average is then multiplied by 3, where the relevant period is a quarter. An entity is classified as having irregular turnover where 2 elements are met. The first is that in any quarter in the 12 months before either 1 March 2020 or the relevant test period, the lowest GST turnover is no more than 50% of the highest GST turnover. That is, there needs to be a variation in the GST turnover of at least 50% between 2 quarters in the 12-month period. The second requirement for access to this test is that the turnover is not cyclical. So that is, the alternative test won't assist a business where income is generally concentrated in the same period ordinarily. So, for example, many agribusinesses would be in that category. Test number 7 is for sole traders or partners in a small partnership who suffer a sickness, injury or who take leave during the comparison period. This test only applies where the partnership or sole trader do not have employees. For it to apply, either the sole trader or one of the partners needs to not work for all or part of the comparison period due to illness, injury or leave, and the GST turnover of the sole trader or partnership was impacted due to this absence. In this case, the alternative test is to multiply the GST turnover for the month immediately preceding the absence by 3 to get a quarterly amount. And the final alternative test listed up there is the temporary cessation test. This test is new to JobKeeper 2 and it provides relief for businesses which may have, for various reasons, stopped trading in the comparison period in 2019. This test was announced and enacted after the initial JobKeeper 2 package was released, and qualification for this test relies on meeting 4 criteria. The first is that the entity's business has temporarily ceased trading due to an event or circumstance outside the ordinary course of the entity's business. So this would encompass events such as moving premises or repairing a premises due to a fire or storm. Note that the event must be outside the ordinary course of business, and therefore where a business would ordinarily cease trading during the period, for example, during an off-season, that won't satisfy the criteria. The second requirement is that the temporary cessation lasted for at least a week. The third requirement is that some or all of the relevant comparison period occurred during the time of the temporary cessation. And finally, the business needs to have resumed trading before the 28th of September 2020. And where an entity meets the requirements to access this test, the comparison period is one of either the same period in the year immediately before the entity ceased trading. So for example, if the relevant comparison period is the September 2019 quarter, the new comparison period is the September 2018 quarter, or the 3 months immediately prior to the month in which the business ceased trading. So for example, if an entity ceased trading on the 15th of August 2019, the period for which the comparable turnover is calculated will be 1 May until the 31st of July. And an entity can choose which of the 2 tests it wishes to apply. The other final item to mention before I move on is that for entities which qualified for either the bushfire lodgement and payment deferrals or the drought help concessions, the entity may exclude the months covered by the deferrals and use the nearest month before or after the period covered by the deferral or assistance. Okay, so I'd now like to move on and discuss the changes to the rates and the amounts claimable. So JobKeeper 1 provided a single rate of $1,500 per employee, regardless of the hours worked or the pay received. And some may recall that this created some controversy at the time, particularly around part-time student workers, which brought about some change, particularly for individuals who were under the age of 18, but by and large, there remained a single flat rate. JobKeeper 2 changes this. It provides for 2 payment periods and 2 different rates for each payment period. Which rate applies depends on the number of hours worked by the eligible employee or the numbers of hours in which an eligible business participant is actively engaged in the business. Active engagement includes actively operating the business or undertaking business development or regulatory activities. To be eligible for the higher rate, an employee must have worked at least 80 hours in the most recent 28-day pay cycle, which ends either before 1 March or the 1st of July. Where the pay cycle is fortnightly, the 80-hour test will apply to the 2 most recent fortnightly cycles ended prior to either 1 March or 1 July. For employers who operate a monthly payroll, the hours worked will need to be apportioned. So for example, if an employer pays monthly for the month of February 2020, the employee will need to have worked approximately 82.86 hours in that pay cycle. For eligible business participants and religious practitioners, the test applies to the number of hours worked in the month of February 2020. Paid annual and sick leave and public holidays are included as hours worked. However, unpaid leave is not included. For eligible business participants to be eligible for the higher rate, they must also provide to either the entity, if they're operating through a company or a trust, or to the commissioner if they are a sole trader, a declaration in the approved form. And this is very important. Eligible business participants will not be eligible for the higher rate unless this declaration is provided. And where an employee is employed in both the period before 1 March and 1 July, the employer must review the hours in both of these periods and base the rate on the higher number of hours. And I've got an example around this shortly. There will be some circumstances whereby the employee, for various reasons, did not work at least 80 hours in the relevant 28-day cycle, and the rules address this by providing a series of alternative periods that can apply in certain circumstances. For employees, the alternative period that can be used in one of the following circumstances: total hours worked in the period did not represent ordinary hours worked. The employee was not employed during part of the period, but note that they must be employed by either 1 March or 1 July, or employment commenced between either before either 1 March or 1 July, but the first pay cycle ended after this, or the final circumstance is that there was a change in ownership of the business. So where one of those tests is satisfied, the first 28-day cycle ending on or after 1 March or 1 July may be used. And note that where the pay cycle is less than 28 days, the cycles must be consecutive to get you to the 28 days. Where an employee does not qualify for more than 80 hours under the standard qualification test, the employer must consider if one of the alternative tests applies to get the employee up to the higher rate. There are also similar tests available where the eligible business participant did not work for 80 hours in the pay cycle. Similar to employees, the alternative reference period can be used where either the total hours worked did not represent usual hours, in which case the period to be used is the most recent 29-day cycle ended before 1 March, which shows typical hours. The individual commenced participation after 1 February 2020, in which case the relevant period will be the 29-day period commencing when the sole trader commenced the business, or if the business was conducted in a declared drought or natural disaster zone during February 2020. In that case, the reference period is the most recent before 1 March where the business was not conducted in a drought or disaster zone. There may be some situations where the number of hours worked are not readily ascertainable and therefore eligibility of employees can't be determined. Where this is the case, so long as one of the listed criteria are met, the employee will be deemed to be eligible for the higher rate. And the listed criteria are that the eligible payments to the employee were $1,500 or more in the 28-day period. Under an agreement or contract or similar document, the employee is required to work more than 80 hours in the 28-day period, or it is a reasonable assumption that the employee hours were 80 or more. And any reasonable assumption would need to be documented in the event that the ATO were to review it. Where one of those criteria are met, the employee will be deemed to be eligible for the higher rate. Okay, so I will now turn to the relevant rates. Where an employee or a participant qualifies for the higher rate, the entity will be entitled to claim JobKeeper for those individuals at a rate of $1,200 per fortnight up until 3 January 2021 and $1,000 per fortnight up until the 28th of March 2020. Where the employee or business participant does not qualify for the higher rate, the amounts per fortnight are $750 and $650 respectively. Entities need to notify the ATO of the relevant rate for each individual, and failure to do so will make the entity ineligible for payments until the notification is made. There is no requirement to re-notify in respect of the 4 January to 28 March period, and there is also a requirement to notify employees of the rate that has been declared to the ATO within 7 days of the notification. Finally, just a reminder, as with JobKeeper 1, that the amounts must be passed on in full to employees and that the payment of super on the amounts is optional. So I've just included here an example where in the pay period immediately before 1 March 2020, which in this case is 2 fortnights, the employee has worked less than the 80 hours, but in the 28-day pay period before 1 July, the employee has worked more than 80 hours. In this case, the employer will be entitled to claim the higher JobKeeper rate for both periods. If, for example, both of the hours were below the 80-hour mark, the employer is required to review each of the alternative tests discussed in relation to determining hours, such as if they were non-regular hours worked, to determine if it's possible to qualify for the higher rate. So the emphasis is really on the employer to ensure that the employee can get the higher rate wherever possible. So I've just also incorporated two final slides, one a graphical summary of the periods and amounts, and the second is a summary of the minimum amounts to be paid. I won't talk any further to these other than to note that I understand a copy of the slide deck will be available, so if anyone wishes to refer to them later. And with that, I will hand back to Sam, who's going to talk through a few tips and traps to navigate. Thanks, Sam.
Yeah, thanks, Belinda. Look, you probably won't find this in any government announcement or press release, but the government has obviously been concerned by the relative ease with which some businesses manage to qualify for JobKeeper 1. And what we've heard from both Michael and Belinda is the mechanisms by which the government has tightened those restrictions. And it's really, I guess, with the benefit of time and hindsight, the government has deliberately removed a lot of that flexibility that allowed some businesses, and there's an argument as to whether they are worthy or not of accessing JobKeeper 1. Now, clearly, the big restriction with JobKeeper 2 is the removal of the ability to use projected turnover and instead only allow the use of actual turnover. But some of the other ones that we've discussed is the inability to choose which is your comparison period other than where you might qualify for an alternative test. We've also heard that there's no longer a choice as to how you calculate the time of supply for GST purposes. Now, all of that being said, there still is a little bit of flexibility within the alternative test that Belinda went through in quite a lot of detail, particularly the substantial growth test that Belinda spent a bit of time on. And maybe to help bring that to life, effectively, if you're a business today that is looking to use the substantial growth test, you effectively have 6 ways of meeting the precondition. You can look at your month of February to determine whether you've had 50% decline, 25% decline, or 12.5% decline relative to February 2019, August 2019, or November 2019. So you've got 3 periods there you can look at, and the same goes for if you were to choose June 2020 as your relevant period to try and satisfy the precondition. And then once you worked out one of those 6, it then allows you to use, or you then have to use the 3 months ending that particular period. So there still is some flexibility, and for some businesses, they may not be aware that there still is a little bit of choice around how you calculate your substantial growth test. One of the other areas that has really caused a lot of our clients' concern and questions I get asked a lot is, what actually do you include in GST turnover? So we know that you include GST free and you don't include input tax, and you effectively have to recreate your suppliers between GST group members. But what about things like adjustment events? Now that might change how you report something at label G1 of your BAS, but the ATO has been very clear from the start that you don't actually include the effects of adjustment events in current tax periods that relate to sales that happened in a prior period. So if someone had a sale in the quarter of June that was ultimately cancelled in the quarter of September, you don't include the reduction in the September numbers on account of that adjustment event. The interplay between GST free and input tax, a lot of business systems are set up to not actually work out which of those 2 categories it is. So quite often you see input tax categorized as GST free. Quite often you see things like management fees going offshore treated as input tax. It's important to look at how those are categorized within your business systems, because just because it was miscoded 20 years ago is not a good enough reason for not looking at it today if you're seeking to make a JobKeeper claim. A lot of businesses, whether because of the drought and other natural disasters, or whether because of business continuity or discontinuity for that matter, have made insurance claims. The proceeds of those insurance claims are not included in JobKeeper. It's important to note that in that context, there's no supply for consideration. Again, supplies between GST group members, ordinarily not included on the BAS, but need to be included for JobKeeper purposes. So there will be a mismatch between what you report on your BAS as compared to what your JobKeeper claim and declarations will look like. One of the other areas that was within JobKeeper 1 that was quite concessional was the fact that if you had a major capital asset sale in 2019 or your comparison period, that was included, which meant that to show your decline to 2020, if you had a similar capital asset sale in 2020, it was excluded because capital sales or proceeds from capital sales are not included in projected turnover. But because we're now dealing in just actual turnover, sales of capital assets, whether in the September quarter or whether in the comparison period, are included. So there is now consistency between the two. And one of the final ones to consider is there's a lot of government money flowing to businesses, whether as grants, as reimbursement schemes like JobKeeper. Some of those grants may be included within turnover, but most of them generally aren't. So JobKeeper is not included because effectively a business is not really providing anything back to the government in return for the payment. So it's important to look at the terms and conditions under which a payment is made. If it's just money for the fact that you've suffered a decline or your business is in a particular industry, it's generally not going to be included in turnover. But if there's an agreement with the state or local council that you will do something in return for the payment, it is generally included for turnover purposes. The last substantive topic that I wanted to cover was around record keeping requirements. I won't go through this in a lot of detail because most of that detail is actually on the slide, but it's important to bear in mind that within JobKeeper, and this hasn't changed, but within JobKeeper 1 and 2, there are both pre-payment obligations as well as post-payment obligations. So effectively, if you're making a claim, at the time that you make the claim, you must have documents that evidence your decline in turnover. Why were you eligible for JobKeeper? You have to actually have records of it before you make the claim, as opposed to putting those documents together once the ATO starts knocking. Similarly, you need to keep post-payment records. So this would be wage and payroll records, any other records that relate to or evidence or substantiate the claim. These JobKeeper record keeping requirements are in addition to the general requirements, which aren't superseded. They exist in addition to, so you generally need to keep your records for at least 5 years. And there are very specific provisions that exist in the Income Tax Act, the GST Act, and other tax acts around record keeping. So it's just important to bear in mind that they exist. More broadly, if the ATO were to come in and look at a claim and say, you don't have sufficient records, that goes towards the ATO's view of you within the context of justified trust. So there's obviously all sorts of justified trust programs, top 1,000, top 100, next 5,000. A lot of it relates to governance and processes and record keeping. So this all goes to that as well. Perhaps not a tax issue, but more of a reputational issue. What would the impact be with employees who thought they were eligible for JobKeeper, but because you didn't have the records in place, the JobKeeper claim has been rejected. That would create issues both with your employees, but also more broadly in the market. In this slide, which again, we won't spend any time on, what I've done is just extract some of the questions that we've seen at the ATO ask as part of JobKeeper reviews. The reviews will continue. They definitely do exist. We've had a number of reviews of our clients. and the more prepared you are for a review, the better. But you can see on the slide the types of questions the ATO is asking, and their ability to come back and clarify and refine the requests is unlimited. So you need to be prepared for an ATO review. As a result of an ATO review, one of three things could happen. The ATO will accept your claim, and we hope that's the answer. The ATO could reject the claim, but allow you to keep past payments. But the ATO could also reject the claim and actually make you pay back the historic amounts paid. You may also be liable for penalties. You may also be liable for interest, and hopefully no one on this call, but potentially there's you could be prosecuted for fraud if you falsified records and didn't actually suffer the decline that you stated you did. So the key takeaways that I wanted to mention, obviously there are different rates that exist for the two tranches of JobKeeper 2. There are different payment amounts, again, for the different types of employees or the hours worked for those employees. There are notification requirements, but generally you will only need to notify the ATO once. If you were previously enrolled, it's a much easier process than if you've never been enrolled in JobKeeper before. And there are some very strict deadlines around when you need to tell the ATO and when you need to tell your employees certain things. So bear those deadlines in mind because they impact upon your ability to actually get payments from the ATO. If you fail to make your declaration, if you fail to get your nomination forms in place, you're not entitled to payments. So with all of that said, and with about 6 or 7 minutes to spare, I might hand over to Michael, who will run us through the questions we've been asked. We've got quite a few. So maybe, Michael, if you just want to go through some of the Q&A that people have asked throughout the session.
No problem. So let's start with this one. So this question is, if you were a full-time employee until the 31st of July and your employer claimed JobKeeper, and at the same time you were a director of your own business working 20 hours, can you claim business participant JobKeeper for October to December? I think the point to make on this question is that an employee can only be a beneficiary of JobKeeper from one entity. So if, in that case, if the person's employer were claiming JobKeeper in respect of that employee and continue to do so, then they would not be able to claim as an eligible business participant of their own business for October to December. All right, next question. What if an employee were on leave, for example, leave without pay, for both quarters and returned to work in August full-time or part-time? Sam, would you like to address that one?
I might hand
or Belinda?
Yeah, with that one, I think that you would need to assess under one of the alternative tests where you, I guess, the employee would not have worked regular hours in the reference period. So you then might be able to have recourse to a period in which they had worked their normal regular hours to determine eligibility. So if in that period they would normally work 80 hours, absent the sort of the paternity leave or maternity leave, then you would be eligible for the higher rate. If they wouldn't normally work the 80 hours, then you would be the lower rate.
Okay, let's have a look at this question. A company started a new business activity under the same ABN in February, but had to close the premises from March onwards due to the lockdown. JobKeeper was claimed for employees in this activity as the turnover was nil, although the turnover did not decline by 30%. Was this a valid claim, and will the Commissioner's discretion apply?
It's an interesting question. I take it here that even under the alternative test, so if the business didn't exist in the comparative period last year, and it's a new business that was created post, let's say post July 2019, but pre 1 March 2020, if your comparative period is low or zero, and you're comparing it to zero you haven't really suffered a 30% decline, which is, I guess, fundamental to the entire JobKeeper scheme. So if you're comparing 0 to 0, that's an invalid claim. But if you're comparing a fairly low number from your comparative period to 0, that would be a valid claim, assuming you can satisfy an alternative test.
Okay. Next question. What would be the definition or circumstances where the basic test is not satisfied and you could use one of the alternative tests? In JobKeeper 1, you could use the alternative tests without question if you did not satisfy the basic test. JobKeeper 2 seems you need an event or circumstances outside the usual business setting that resulted in your relevant comparison period in 2019 not being appropriate. Belinda, would you like to take that one?
Yeah, so that's correct. So with JobKeeper 2, to use one of the alternative tests, you need to qualify for sort of meet the requirements of the criteria for each of those specific tests. So for example, you need to have a disposal in a business restructure in a period, or you need to have ceased trading in the period, or you need to have had, a rapid increase in turnover in the period. It's not automatic that you get to apply one of the alternative tests. So if you fail what I call the standard test, you then look to see if you can access any of the alternative tests. If you can't access any of the alternative tests, then unfortunately you won't be eligible for JobKeeper 2.
Okay, thank you. I see we are almost at time, so I'll just pick another one of these. So in relation to adjustment events, for monthly JobKeeper 2, if, for example, a sale was made in August, but these were then refunded in September, can we include the adjustment as they are within the same test period, being the September quarter?
So if they happen in the same BAS reporting period, then you actually don't have an adjustment event as such. So that's okay. So maybe to simplify the example, if you had a sale on the 1st of September and then on the 28th of September that sale was cancelled, that's not an adjustment event. So the effect of that is that there's nothing to be reported. It's different when they cross over from a BAS reporting period into another BAS reporting period. And that's really what the ATO is concerned about, is that there are sales that are in an earlier comparative period or in one of the alternative test comparative periods. And then when you're comparing it to your current, be it September quarter or your December quarter, the effective adjustment event has to be removed. So if they're in the same quarter, that's okay, you take the net effect. If they're in different quarters, you have to adjust for it. Maybe adjust is not the right word, but you have to remove the effect of the adjustment events.
All right, that brings us to time. We do still have some questions we have not yet got to, but we can answer those in the context of the post-webinar communications that will be out. Sam, were you going to wrap up?
Yeah, so look, I just wanted to thank obviously everyone for making the call. Appreciate it. It's a busy time for everyone. Like I said, hopefully this is the last JobKeeper session, but I guess we'll wait and see. But I just wanted to thank everyone for their time, and I hope everyone has a great rest of their day. Thank you.